Hello, everybody, and welcome back. China's reopening is a positive signal for stock markets, but there are new uncertainties. What opportunities do Asian equities offer in the current environment? I talk about this today with my guest, Chris Chan from EFG Asset Management under their brand New Capital. Chris is a senior portfolio manager and manages the New Capital Asia Future Leaders Fund. A warm welcome to Chris.
Great. Thanks for having me.
Chris, the drastic COVID lockdowns in China have been history for a few days now. So how does the research and recovery affect Asian equities in general?
So I think, when you look at the year-to-date performance of the China stock market, it probably surprises a lot of investors, ourselves included, that actually, the China stock market is pretty flat, which of course, lags Europe and the S&P and of course the Nasdaq year-to-date. Now, this is despite what we could argue has been a recovery. There's no question in our mind that directionally things are improving. But I think what's taken a lot of investors by surprise is the magnitude of that recovery. And you can really see that coming through in certain select areas of the economy. You really had that first derivative of the recovery coming through very strongly in terms of the service side. You saw the tourism numbers domestically and now internationally picking up very strongly. People are eating out much more. So that really has improved and actually at higher than pre-COVID levels already. But actually where there's been you could argue a disappointment is on the more consumer goods side, particularly the high ticket items, whether that remains to be smartphones, autos, PCs, sportswear, for example. A lot of these key areas are much weaker than people would have hoped as of, November, December last year. And so I think when you look back in terms of, what's driving this still apparent caution when it comes to the consumer spending, and again, that's kind of shown by, credit growth has started to taper off a little bit. Deposit growth and savings rates remains pretty high. And one, explanation is, you are seeing very high youth unemployment, which of course are a big source of this consumer goods spending. So that does remain to be a little bit of an overhang in terms of the overall sentiment. And therefore that spillover effect and potential benefits to the rest of the region is yet to really come through. You are seeing tourism numbers improving in, of course, other areas, but not enough to really drive economies such as Thailand, and imports still remain very weak, so not benefiting the more export-orientated areas such as Taiwan and Korea.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
So where are the current investment opportunities in Asia when the majority of investors are talking about a global economic slowdown and eventually a recession in Western countries?
Sure. So I think this is actually where the Asia investment case perhaps looks a little bit more interesting from a relative basis compared to, developed markets such as, the US and Europe. And I think, we all know that the weaker dollar, which, you could argue potentially has the potential in terms of what's going on in the Fed tapering side. If you do get a weaker dollar, that generally that is more positive for ASEAN markets or Asia markets. But I think the other point is, behind that is when you look not just in China, but, every market, whether it's India, the Southeast Asian countries, but even, Korea and Taiwan, they didn't loosen monetary policy anywhere near to the same extent as developed markets during COVID. So what that means is the inflation, as of course it did rise, just like it did elsewhere in the world, inflation's levels didn't really reach that extreme level versus their targeted range compared to those levels. And so therefore they haven't needed to tighten as much, which of course is what typically drives the economic slowdown. So you can see that in areas such as India and Indonesia, that inflation has come down quite nicely over the past few months to the point where already the central banks in those countries have paused rates. And so you could argue that they're actually much better positioned monetary wise because they're not had that aggressive tightening. And therefore, that offers a lot of upside potentially supported by the more beneficial monetary policy versus developed markets.
International investors are spooked by China's more assertive behavior and its position in the Russia-Ukraine war, but also the Taiwan conflict. How do you respond to these investors? How do you deal with these political risks?
Sure. So it's obviously a very fair and very key concern that a lot of investors, of course, our own investors have. And I think it's not, of course, just the Russia-Ukraine war. You can kind of put it into three major buckets. You do have the Russia-Ukraine war, and obviously China, and their stance there. Of course, Taiwan remains a huge concern and overhang for Asian markets as a whole. And of course, the underlying concerns in terms of the tensions between the US overall, particularly on an economic sense. And, first and foremost, we don't believe geopolitics is going to go away anytime soon. Very much this is here to stay. And unfortunately, this is something that, any Asia investor has to get used to. But I think when you kind of dissect those three buckets, if we look at the US economic tensions, really, I think what will drive the stock market up and down is actually the relative improvement or deterioration from where we are. And, you could argue that if you look over just the past few weeks, there's been a marginal improvement. Biden came out in just the last few days and himself, talked about he expected to see these so-called tensions thaw very shortly. They've clearly started high-level government official meetings, a couple actually over the past just 2 weeks. So that communication has clearly started to pick up after many months of essentially no meetings. And you can see in smaller areas such as solar panels, there's been a little bit of a compromise there where actually Chinese solar cells can now be supplied to the US, assuming that end modules are produced in the country. So that's a marginal positive, putting it all together. On Taiwan, clearly this is always going to be an overhang for many years to come. But again, I would point to Biden even just last year saying he didn't even see himself the Taiwan invasion as being an immediate threat. And we do think that we don't see any risk of that for a good few years from everything that we're seeing.
After 2 years of losses, question arises about a possible entry or re-entry. Are Chinese equities currently cheap, and how do you assess the risks for Chinese equity?
Sure. So I think there's no question that at least versus history and developed markets, notably the US, it's hard to say that China is not trading cheap. I think if you look back on a 5 or 7 year trading history, the MC China is trading on about 10 times forward PE. Typically that's at the very low of a trough of that trading range. And again, the same goes for plotting that the valuation against the S&P. It's certainly at that trough level versus history. So clearly that suggests that there's upside from a valuation point of view. But of course, that alone isn't going to stimulate buying and interest. You really need the second element of stock market returns, which is the fundamental earnings to really pick up much stronger than perhaps we've seen year to date. I'll go back to what I said, that despite the recovery not being as strong as people expected, it is fair to say the direction as across what we're seeing, property, infrastructure, and consumer, is still up. So we believe that given how attractive valuations are, if the fundamental earnings trends continue to improve, continue to be in the right direction, particularly relative to, for example, US equity over the next 12 to 18 months, then clearly that's going to give a lot of investors food for thought when it comes to re-entering the market.
Indian equities were one of the few asset classes to perform positively in 2022. So is India currently a better choice than China?
Well, I guess it depends on the time frame you're looking at. I think, shorter term, there's perhaps the argument that, India still is looking very expensive. We talked about how cheap China was looking. At the end of last year, India was trading at about 2 times above its standard, its average in terms of its 2 times standard deviation. That's moderated a little bit to 1.5, but again, still far above its historic norms. So valuations are much less supportive in India. The other point is, whilst top down, clearly inflation is a big risk for the Indian economy. But as we said before, that is starting to moderate. The Bank of India has paused rates, which of course should be positive or supportive for the economy. So that's clearly a plus sign. And fundamentally, the economy is still very robust, actually much stronger and more robust than you could argue in China across the board. So we prefer it longer term than China for various reasons in terms of the consumer segment, much more underpenetrated, much more supportive demographics. We like what we're seeing in terms of the industrial side, a very strong public and private capex cycle, very strong property cycle. But we think perhaps shorter term, because it's coming off a higher base compared to China, both fundamentally but also valuation wise, perhaps in the shorter term, 6 months, maybe China has a little bit more potential. But longer term, we prefer India.
Directly connects with the next question. So can Indian equities build on the momentum of 2022? And in which industries are you interested in India? And what are the risks and opportunities of Indian equity investing?
It's because it's the economy remains robust. There are still, it's still a little bit of a mixed picture, which is great actually for so-called active stock pickers, because there's a lot of dispersion opening up in India for sure. I think on the slightly more negative side, and I would say only slightly, of course, you have the IT services side, which of course is more driven by US and European business confidence and budgets. That's clearly suffering a little bit, as you would imagine. The banking side was one of the strongest performing sectors last year in India, remains a long-term, very attractive investment case for us and many investors. But again, I think on a 12-month basis, whilst trends remain strong, we think actually a lot of the upside perhaps has played out in terms of already maxed out in terms of credit growth. Asset quality is about as good as it can get versus history. So actually what we've been doing is rotating into other areas of the economy, such as the industrial side. We pointed out how strong the public capex cycle is, driven by the government receiving much more tax collection as they changed they changed the GST a few years ago. That's feeding through into very strong construction projects. That's also benefiting from private capex, in part because of this government scheme, production-linked incentives, which is attracting a lot of foreign investors and investment. So you're really seeing that twin engine of public and private capex, which is driving very strong industrial demand for various components, whether it's specialty steel, wires, cables, and the like.
So we touched the danger of a potential a recession in developed economies. So what impact would have a slowdown on the attractiveness of technology stocks, for example, semiconductor companies, especially in China, South Korea, or Taiwan?
So Korea and Taiwan is quite an interesting one, because if you look at it, the Taiwan and the South Korea market has been the strongest performing markets in Asia year to date. But when you actually look at the earnings revisions and the earnings trends, they're still incredibly weak, and you're fully expecting double-digit earning decline year on year this year versus last year. And when you look at the end demand, particularly in areas such as PC and smartphone, it's fair to say you haven't really seen an improvement. And that's why this so-called IT recovery story has been pushed out from Q1 to Q2 and now arguably Q3. But saying that, we do think there's a lot of potential still, because what we're seeing is in select areas of the IT chain, for example, the memory, which is typically an early cycle indicator of the overall IT cycle, you are seeing pricing in certain products bottoming out. You're starting to get the benefits of these so-called production cuts by the key players. And, we expect then the earnings have started to bottom. You can see that in the inventory levels of key hardware. Again, PCs, smartphones being the key ones. They've reached that historic normalized level of inventory, which allows them then to start restocking, which in theory should support the pricing of a lot of these semiconductors going forward. So we do think we're reaching the bottom there, albeit part of this has been priced in, given how strong the IT cycle sector has performed year to date.
This was Christian from EFG Asset Management and their brand New Capital. Chris, thank you very much for being with us today and sharing your insights into Asian financial markets.
Great. Thanks for having me. Thank you.